given that the demand from China and other East Asian nations, seem to be continuing apace. They're continuing to get hold of virtually every ton of gold that becomes available. So, yeah, the liquidity situation I don't see really improving.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for May 12th through May 19th, 2025, while supplies last. First this week, we feature backdated 1-ounce gold American Eagles at just $89.99 over spot per ounce. 1-ounce 2025 silver American Eagles are just $4.99 over spot. Next, we have 10-ounce silver Royal Mint coins at just $2.99 over spot per ounce. The 10-ounce Britannia, 10-ounce Royal Arms, 10-ounce Little John, and 10-ounce Merlin are all 4.9s fine. And we have a very limited quantity. Again, they're just $2.99 over spot per ounce while supplies last. Next, backdated 1-ounce gold Canadian maples are only $69.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. I'm your host, Dunnigan Kaiser, and our guest today is well known to most of our viewers and subscribers. Alasdair Macleod, a former bank director and head of research, joins us today, Thursday, May 15th, 2025. Alasdair, thank you for returning back here on Liberty and Finance.
That's my pleasure.
Your perspectives, both as a former bank director and a longtime researcher of the precious metals and financial markets, as well as your headquarters there in the UK, gives you a European vantage point that is very beneficial to us as we look to an international perspective on a lot of the financial and monetary issues that affect us. We are going to ask you some viewers' questions that were submitted ahead of your arrival. That'll be coming up in just a few minutes. But first, if we could talk with you about your latest research that's going to be coming out about the implications of Say's law versus Maynard Keynes's general theory, and why the role of government as a dominant player in major economies around the world has really upset the tables of efficiency and productivity in our financial lives. And also, your recent interview with Igor van Greyers is going to be of interest. We'll put links to both of those in the description of this video. Could you first talk to us about your recent inspection of the contrast between Say's law of economics and Keynes's, and why it's been affecting all of us so dramatically?
Yeah. Well, I think virtually everybody today has forgotten what Say's law was. It was described incorrectly by Keynes in order that he could dismiss it, which he did in literally the first 20 pages of his general theory, which was the one book really that launched macroeconomics. What Say actually described, I mean, he didn't sort of come up with a law, an aphorism, let us say, in one sentence or two sentences, but he wrote a book, which was quite a long book. It went around to 6 editions. I think the final edition in about 1805. Really what he did was he described economics. He described how free markets worked. He described the division of labor, why it is that people specialize. If they got a particular skill, then they maximize their income by deploying it. So instead of, let's say, trying to produce everything that you need as an individual, no, what you do is you specialize in something, and other people specialize in things, and you use money to buy the things that you want, having made the money yourself by selling your product. And
I want to interject a personal anecdote right here, if I may, and that is my wife and I have been devoted to self-reliance and self-sufficiency for some time as a preparedness thing, and we have our own wheat mill and dough maker that we use for making 40 loaves at a time of whole wheat bread, that sort of thing. We really wanted to try gluten-free, long fermented sourdough, and plunged right ahead thinking this will work just great. And 2 weeks later, we got 4 loaves of long fermented sourdough spelt bread. And I thought there's got to be a better way. We're going to have to find somebody who's really good at this and let them do it. And we'll do what we do well until the time comes where maybe we have to do this for ourselves. It would be much wiser for us not to be necessarily doing that every time. So go ahead.
There you go, the division of labor. I mean, there will probably come a time when you can't divide your labor because, the credit is gone. Credit, which we think is money, is actually gone. And the other thing that he pointed out, actually, which is very, very important, is that there is a time element in everything. If you're going to go and earn some money, then you have to make something first. In other words, the order of events is you produce something, you sell it, and then you can go and spend the proceeds of your whatever you've raised from selling your product on the other things in life that you need. So what this means, and this is very, very important, what this means is that if you get what we call today a recession, then you will find that the supplies of goods and services will diminish along with demand. And so consequently, and probably slightly ahead of demand, in fact. So the idea that you have a recession and that lack of demand will mean that the prices fall is actually completely wrong. There will be changes in the prices of different things. There always are when you get changing circumstances in the economy. But basically, what Keynes had to do in order to create room for government to intervene, he had to dismiss Say's law so that he could invent, if you like, a role for government intervention. Now, he published this book, his general theory, in 1936. And ever since then, his following, if you like, has increased. And, amongst economists, many of them, he had almost a godlike status. But it's completely wrong. It's completely false. The suppositions based on it are completely false. And anyone who's got the tolerance and the patience to read through the whole of his general theory will find that his conclusions at the end of his general theory are absolutely nuts. He wants to do away with savings entirely. He thinks the government can make available the capital to the individual who, will basically not be driven by profitability, but by the love of what he's doing. Come on. It's, if you like, a different version of a sort of communist approach. Mm-hmm. And this is the man who invented macroeconomics, which we all follow. I mean, everybody is tied into it. When you get a government statistic. Now, you and I know that government statistics are, if you like, self-serving at best and probably downright lies at worst. But this is all part of the macroeconomic thing. It's a relationship between prices and what it should do with money supply and all this. That's all macroeconomic rubbish. And it all justifies government intervention. So I think anyone who is interested in understanding why everything is actually going horribly wrong should really look back and read what Jean-Baptiste Say actually wrote in his treaty, which, as I say, was the sixth edition was published in about 1805. And just ask yourself a question. How have we progressed in terms of our understanding of things from then? And the answer, unfortunately, is a big fat zero because of all the Keynesian lies. And you'd be amazed. I mean, I've had correspondence with very senior journalists, like in the Financial Times and all the rest of it. They tell me, they deny Say's law. This is what you're told when you go to university and study an economics degree. Say's law is rubbish, but it's not. It actually describes exactly how the economy works. So anyway, I wrote an article on that, and I think it might be of interest to people who, I think they should actually look quite carefully at why things are really going wrong now and understand the root of that error, which is really Keynes dissing Say's law.
You've spoken with us several times about credit cycles, boom and bust cycles of credit, does, in your description here, rather than letting the organic division of labor happen by people doing what they do best, and therefore the efficiency and the productivity of all rising, does the intervention of governments in this process, picking winners and losers and basically making things less productive, does that exacerbate the credit boom and bust cycle rather than letting it play out organically without government interference?
It's difficult to say. What it does basically is that it might smother the credit cycle, basically by increasing the quantity of credit, so that as the private sector gets frightened, if you like, as the banks get frightened about the degree of risk that they have lending into the economy, governments, if you like, step in. This is pure Keynesian stuff. The governments are encouraged to step in and basically make up the shortfall. In other words, the debt creation process moves from the private sector to the public sector. As to whether this is sensible or not, I think that's a very different question. I would say it is not sensible. It does mean that what you're doing is you're kicking the can down the road, to use the phrase which we last used back in 2008, 9, 10. And eventually you can't kick that can down the road anymore. And I'm afraid we're reaching that point.
And that's where I was going with this, is along the way, by not allowing nature to take its course as it normally would have on perhaps a smaller, granular, local, immediate basis, giving an accurate feedback of what services and goods are demanded by the real economy, that sort of thing, does the existence of government subsidies and interventions and currency printing and easy credit distortions and that sort of thing, does it prolong and stretch out the overhang of the reckoning, the day of reckoning, making it bigger and worse?
Yeah, it does. That's absolutely right. I mean, this is what I mean by kicking the can down the road. And I think it's what everybody means by kicking the can down the road. And of course, now we've got another variation on it. Everybody's talking about some sort of reset, in the belief. These are all guys who bought into the macroeconomic meme. They're saying that there's got to be a reset. And who's going to do the reset? Governments, of course. Not you and I as, individuals, or the collective individuals, meaning the private sector and the economy. We're not doing it's not assumed we're going to be doing the reset. It's assumed that governments somehow have suddenly got the wisdom that they can do this, which is absolute tosh. I mean, the other point about it is that when governments do intervene, because they've got no skin in the game, and it's not their function anyway, they're driven by political considerations, they always promote the things that get them elected rather than make any sense whatsoever. And so the distortions just build up and build up. The idea that Schumpeter had of creative destruction, which is really what he saw the credit cycle doing, or the business cycle, as the Austrians called it, that's never allowed to happen. So the creative destruction process, because it's deferred and deferred and deferred, just becomes a lot more violent when it happens. And there will come a point where government can no longer control it. Their answer, of course, will be to debase their currency. You can see this arriving. It's the end point of any analysis of our current position.
The analogy, or even the wording that you used there to describe the government's intervention, reminds me, and I think it's perfectly apt, the interference with, for example, natural wildfires that happen on a small, localized, frequent basis in nature to burn out the undergrowth and clean up the dead wood, that sort of thing, rather than government policies that say, there will be no fires, and therefore we're gonna stomp out every fire. And there will be no logging and no thinning of the brush and that sort of thing. And
we got to ban matches.
Yeah, and well, eventually you end up with huge swaths of real estate being tinderboxes, and you end up with much more widespread wildfires and that sort of thing than you would have had they been allowed to take their course on a natural basis. And it seems like the analogy is what's happening financially. But the other thing you mentioned was government stepping in as an actor in the role of the economy where it has no place. And a fairly non-productive or almost entirely non-productive actor in the economy, and how that not only distorts and prolongs but drags down, because we get these government statistics like GDP, et cetera, and you realize, and you were telling us about this, that most of it can end up becoming government spending, not real economy. And lending and that sort of thing. And the largest employer, is there any aspect of that you want to touch on before we move on to viewers' questions?
Well, I mean, I think it's quite obvious, really, to anyone who really thinks about it. But I mean, in my article, my Substack article, I made the analogy with an electrician who doesn't understand Ohm's law. Ohm's law is the basis of all electrical understanding and also electronic understanding. Now, if you let an electrician loose on your wiring who doesn't actually understand Ohm's law, then he's going to blow you up. And that's basically where governments are. I mean, they don't understand what they're doing. They're not qualified to do it. They're not qualified in the sense that, their motivation is completely separate from that of engendering economic progress, which basically can only happen by allowing private sector actors to progress the economy, driven by their anticipation of what consumers are likely to want tomorrow. It's the basis of all economic innovation and progress. Governments cannot do it. They can subsidize industries, of which there are spin-offs. But then you have to ask yourself, well, what's the cost? And anyway, are these spin-offs something that the private sector would have been able to do on its own? Government is not good. It really isn't.
We're going to talk about the implications of these realities in the viewers' questions section that we're going to get to in just a moment. You recently did an interview with Igor von Greyers of von Greyers Gold in Switzerland, and that link will be in the description of this video for those who'd like to take a look at that and listen. What were some of the very key points that people will find out about if they go and take advantage of that interview?
Well, I titled it "Shooting the Breeze with Egon." Basically, he and I have been, in banking, broking, securities, whatever, since the very early 70s. And I think in Egon's case, he's probably just a year or so older than me. I feel like you could cynically say it's a couple of old men talking. It's talking about things which are really relevant today. We talk about our experiences in the gold market and what we've learned over the years, because it's always a learning process. The problems that government face, how they're likely to react. Egon made the case. He made the point which I've made before, and I was very, very pleased to hear him say it, and that is that the future very much is likely to be China, Russia, Shanghai Cooperation Organization, and BRICS. I mean, we're just killing ourselves economically, whereas they are the phoenix arising from, I don't know, some sort of ashes, I suppose. So the world is going to continue, but not with us in terms of progress. So we were discussing all these points, we agree on virtually everything, having gone through it over the decades. I mean, we've got, 50 odd years, over 50 years, 55, 56 years of experience in these markets. We've come out of it, both of us, learning a hell of a lot. And I think it's the sort of experience and information which hopefully will help guide people through what are obviously going to be increasingly difficult times.
Well, folks, look in the description of this video. We'll put a link to that interview between Alasdair and Egon von Greyers. And now we'd like to turn to viewers' questions. Thank you all for submitting these. It makes this a very lively discussion. if not in real time, certainly these are real questions submitted by viewers today ahead of your arrival, Alasdair. We have two related questions here, both that you are probably better positioned than most to address, and that's about the existence and purpose of gold on storage in the Bank of England and the recent large, some say unprecedented, physical flows of such gold from London to New York. One question from Accidental Homestead says, how much more gold does either the Bank of England or the LBMA have that is considered deliverable and not belonging to some other entity?
We don't actually know the answer to that. The liquidity has very much come from leasing central bank, leasing of central bank gold. I mean, that was clear, and it was proved by the fact that bullion banks were queuing up to take gold out of the Bank of England vaults. I mean, these are banks which have accounts with the Bank of England. So it's possible for them to store some of their gold there, but they would tend not to. Therefore, at least a large amount of the gold that came out of the Bank of England was effectively leased gold, and it was taken by bullion banks who were benefiting, if you like, from the spread between futures, which were trading at a huge rate, interest rate premium. By interest rate, I mean compared with the gold lease rate. It was a simple interest rate arbitrage. Now, that has now stopped. And if you look at the COMEX warehouse gold stocks, they've now begun to decline. So that process is over. Furthermore, it was only week before last, I was in London visiting someone in Throgmorton Street, behind the Bank of England. The doors were firmly shut. There was nothing going in or out. So I think that process is over. But it does raise the question, quite rightly, that, how much liquidity is actually left within the system here? Because we get vault reports from LBMA authorized vaults, as it were, and they have declined a little bit, but not hugely. But most of the gold there is owned by someone, as opposed to being, if you like, the liquidity for the bullion banks to draw upon. So it's an interesting. It's a question we would all like to know the answer to. My guess is there is less liquidity there than the numbers would suggest. Quite a lot less liquidity. I wouldn't be surprised if we're looking in the hundreds of tons rather than the thousands of tons. So, and this is very important, given that the demand from China and other East Asian nations, seem to be continuing apace. They're continuing to get hold of virtually every ton of gold that becomes available. So, yeah, the liquidity situation I don't see really improving.
Related question, and these are from two different questioners. The same questioner asks, I have heard that the Bank of England or the LBMA will no longer send gold to the COMEX for delivery. Is this true? And the second related question is from E. Burkett, 9969. If the USA had hypothetically repatriated 600 plane loads of gold, how would that change the financial landscape of the world and possible initiation of a gold standard?
The first question as to whether the LBMA and the Bank of England refused to send any gold over to the other side of the Atlantic, I don't think that's quite the way it works. Basically, if you have gold or you have leased some gold and the opportunity is there, that is what drives the move over. It's actually got nothing to do with the LBMA, so long as the members of the LBMA behave within its rules and regulations. As far as the Bank of England is concerned, there is a problem because if you lease gold, then that gold is your property over the duration of the lease. And it could be that if you lease gold, say for, let's say 5 years or something like that, which not unusual, I would suggest, then you can pass that gold on to other people. Rehypothecate it. Because, why do you have gold? You have gold basically as a bank to use as collateral, to collateralize deals. So I think from both the LBMA and the Bank of England's point of view, they're rather limited in terms of what they can do to discourage gold from flowing across the Atlantic. The market would probably do it, if you like, insofar as if there is a shortage of gold in London, then the lease rate should rise. And that might generate a bit of interest, if you like, to get gold back. And if you look at the last vaulting figures, I think I'm right in saying that the Bank of England numbers were down a little bit, but the LBMA numbers were up a little bit. Now, it's not the total thing, because the LBMA vaults, which are recorded, are vaults within the M25, which is the circular motorway that goes around London. There are other vaults outside, I guess. And also, of course, we've got other vaults in other parts of the world, particularly places like Switzerland and so on. So, this is just part of the whole situation, as it were. And I think it would be a mistake to read too much into fault moves, if you like, changes in faulting levels in London and also in the Bank of England. Remind me what the second part of the question was, TBA.
If there have been a unprecedented move of physical gold to the U.S., perhaps to replenish the Treasury, would that imply anything about a potential move to a gold standard? And if so, how would the implications be financially around the world?
Well, so far as we are aware, the Treasury is not involved with this movement of gold at all. If it was, then this gold wouldn't be appearing in the COMEX warehouse statistics. And furthermore, I think that anything that the US Treasury does will not be divulged. So we really cannot draw any conclusions at all. All we can do is drum up some conspiracy theories. And that's not something I'm really prepared to get involved with.
You've spoken with us for quite some time about the foreigners typically being the first to recognize the weakness of a country's currency long before the domestic citizens of that country recognize it, and therefore they're the last to take protective actions. Richard D59E says, we hear about foreigners dumping U.S. treasuries. Who's buying them?
Well, good question. I mean, they're bought in the market by presumably U.S. pension funds and U.S. insurance companies. They are being bought, let us say, also by offshore insurance companies. I mean, places like the Cayman Islands have a lot of captive insurance businesses, which are American in terms of their underlying liabilities. So they would buy them to match their liabilities. But of course, if you've got sellers in the market, if the price is driven by sellers, then the prices are going to fall. In other words, the yields rise. I would say, however, that after the initial scare from the Independence Day on April the 2nd, and particularly since Scott Bessent actually took control over the matter and met the Chinese in Switzerland, things have calmed down quite a lot, which I think is good. It really is. I mean, Scott Bessent, I think, is, if you like, the control mechanism on some of the more wilder things coming out of the president, which is great. I think that's very, very good. But it doesn't actually change the underlying problem. Probably what it does is it changes the timing of things. I mean, for example, we've seen gold sell off over the last few weeks, really since it rose up to that 3,500 level. And in declining, you could argue that that decline is because the pressure, if you like, on the whole system, the whole financial system has been relieved somewhat by Scott Bessent coming to a more sensible agreement with the Chinese over tariffs. But the dynamics of the situation are still extremely poor. I mean, basically what we have is, this is something that so few people actually understand, is we've got this credit bubble. It's the largest credit bubble in history. And if you have difficulty trying to understand that, just look at the debt side, because credit equals debt, always. two sides of the same balance sheet. And you look at the amount of debt around, and the amount of debt which is bad debt, particularly as interest rates tend to rise. Now, I know everybody's saying it's going to fall, but that's another Keynesian bit of rubbish. You can see that this bubble is ripe to pop. And I think we've said this, to your audience before, that the situation in many senses is very similar to 1929. You had a credit bubble fueled, if you like, in the late 1920s, the roaring 20s, which then coincided with the introduction of the Smoot-Hawley Tariff Act of 1930. And, we have the same thing today. We've got a massive credit bubble, the largest ever in history, and we have Trump's tariffs. Now, fortunately, Scott Bessent has been taking the worst of that out. But, we're in this sort of dreamland where we think, oh, well, this is the art of the deal. You sort of say something completely outrageous and then you come back. I think, no. Who actually controlled things in Switzerland? It was the Chinese. The Chinese actually, okay, they don't like to see tariffs. I can certainly understand that. But actually, their exports elsewhere are considerably more important to them than exports in America. They have deliberately moved away from a reliance on sales of Chinese goods into America. So, yeah, it hurts a bit. But this is why they were quite happy to raise tariffs, every time Trump decided it was going to be 140%, they would raise them as well. And, which basically meant there was going to be no trade. Who backed off? The Americans. They had to, because they're just so ridiculous. And so the Chinese actually, I think, in terms of the art of the deal, it was the Chinese who actually won that one. And I think you might find that there are going to be further problems, not necessarily just with China, but elsewhere. And of course, the other thing that is done is it's basically united the ASEAN nations, all the East Asian nations, like Thailand and Vietnam and Cambodia and even Myanmar and so on and so forth, into a trade agreement. Oh, and also, incidentally, Japan and South Korea into a trade agreement with China. Free trade. They know that they're far better actually trading with each other than trying to trade with the lunatic policies coming out of America. So it's actually strengthened China's hand in the geopolitical sense enormously. Which I think, this wasn't a policy that was sensibly thought through by the US government.
There's two questions here that touch on things that you've just described, and if you feel that you've covered them fully, then that's fine. If you have anything that these that you want to shed additional light on, that's fine. Mr. J. Pittman 31 says, Alasdair, I hear that May was a record month for contracts at the COMEX being taken in physical gold and also physical silver. Given the ever-increasing demand for metals by central banks, why is the price still being pushed down by over $100 for gold in a couple of days?
Well, it was the May contract, actually, I think, which, has seen record deliveries. But the answer to that is that it's actually a separate issue. If you've got a short position in the futures market, you'll be what are called the swaps, but basically a bullion bank trader. You're taking the short side. So, if you've got to actually deliver something at the end of the day, you might, that's one problem. But basically, you're trying to close your short position. So what do? You bang the market. When things go quiet, you just bang the market and take the stops out. And that's what's been going on. It's as simple as that. Look at the outstanding interest, the open interest on COMEX. It is very, very low, which tells us that these sort of games, if you like, are now facing the law of diminishing returns. And I would suggest, it's fascinating watching the performance today. This is Thursday, what day are we? Thursday, 15th. Overnight, prices were marked down very, very heavily. Now, I would suggest that there is some indigestion, if you like, in the Shanghai futures market, Shanghai Gold Futures Exchange. Overnight, we've seen this a few times during Shanghai trading hours. So that indigestion was continuing, and it drove down gold and silver quite hard. But then what happens this afternoon, our time, sort of mid-morning your time? Suddenly it rallies, and as I speak, I see gold, having been down about 2%, is now up 1.4%. I mean, it's a swing of $100 on the upside. Now, this sort of thing, I guess, we don't know until we see tomorrow, but I guess on not much volume, is indicative of a squeeze on the swaps. I think they are being very, very badly squeezed.
And again, on another topic you were just speaking about Scott Bessent and his role in the foreign appetite or lack of appetite for the U.S. Treasury. Anthony Shepard, 4903, asked, with $9 trillion of U.S. debt and an estimated $2 trillion in deficit spending needed to be borrowed this year, Scott Bessent has stated that he doesn't want the benchmark U.S. 10-year Treasury above 4.5%, yet it has passed above that threshold. What is the bond market telling us, and where do you see rates headed here and abroad?
Well, I think what the bond markets are telling us is that rates are going higher. I mean, and the reason it goes higher is you've got to look at it from the foreigner's point of view. A foreigner, let's say, buying U.S. Treasury debt, he'll be looking at the supply. Not only has he got to find, is he being asked to refinance some of the debt that he holds as it's coming up to maturity. But also, he looks at that $2 trillion-ish deficit. He looks at the prospects for America. He might take the view that it's going to be more than $2 trillion. Does he want to get involved with a yield of 4.5% on a 10-year? That's the way he's looking at it. And not only that, but he's probably overweight in dollars anyway. I mean, when you look at the U.S. Treasury's tick numbers, which what call the Treasury International Capital Statistics, foreigners own something like $40 trillion of currency in debt. 40 trillion. That compares with a nominal GDP of less than 30 trillion. They are horribly, horribly overweight in dollars. And if the global economy is slowing, whether it's China's economy slowing, which some people would say is the case, but trade certainly is being jumped on by these tariffs. Do you really need all these dollars? The answer is probably not. So we have a situation, I think, where you have sellers of dollars from abroad for a variety of reasons, which raises the question, at what level are they likely to become investors again? And that's very, very difficult to see because with America, in effect, in a debt trap, and the definition of a debt trap is that it doesn't have the revenue income in order to sustain the level of debt it has. Under those circumstances, you find that interest rates and bond yields start rising. And as they start rising, the situation just gets worse. And it gets worse to the point where someone actually has to do something about it. And I've said this so many times. We had exactly the situation in, I think it was late 1975, early 1976, when we had to issue, I mean, in the throes of a recession, the government had to issue 3 gilts, in other words, our UK government bonds, with yields of 15%, 15.25%, and 15.5%. Now, I see no reason why US dollar yields won't rise towards that level. And this is Scott Bessent's big headache. How is he going to keep this thing under control? Difficult.
One final question, and that is from El Nino Davida 9310. When we have a genuine price discovery when gold and silver are at all-time highs, what's the end game? Use them directly as money or reliquidate them on the other side into the new financial system?
The latter, I'd say. Because the point about gold, the role of gold is to give credit its value. And so long as credit is not attached in its value to gold, it is going to continue to lose its purchasing power. What we're doing by holding gold is we're getting the hell out of credit. It's really as simple as that. The end game, well, we'll see how it plays out. I wouldn't expect to, rush out and start sort of, buying vegetables and other things, sourdough loaves, by using gold or silver or whatever. But I might use it to acquire some property, when the real value of property is driven down by the crisis that everybody is facing. So, there will be different ways you play it. But I would expect the sensible thing to do is that when there is finally some currency stability, returns into the situation, whether it's with the gold standard or whether it's gone down so far, someone comes in and actually does something about government spending, government finances, and all the rest of it. At that point, you may take a different view as to whether you should continue to hold gold or cash it in for a bit of credit. But we're a long way from there. I mean, at the moment, all it's about is that credit's value is going down rather than gold's value rising. It's not a clean argument because gold's value, if you like, in real terms, is rising as well, particularly against major commodities. But that's a reflection, I think, of everyone trying to get out of credit or increasingly getting out of credit.
Alasdair, for people who want to follow your writing on a weekly basis, where should they get connected?
Well, I have my own Substack, which is alasdairmacleod.substack.com, or if you Google Macleod Finance, it'll probably take you there. And my objective, basically, is to try and help people understand these enormously important issues and to work out how to protect themselves from, if you like, what is actually happening. And I just feel that's terribly important for people to know. I just hope that, the knowledge is, if you like, it's not really necessary. But as we go on, we can see that, it is becoming more and more necessary to understand what is going on. And this is why, occasionally I will write an article about something which is pure economics, like the relevance of Say's law and the irrelevance of what everybody believes. By that I mean macroeconomics, which was invented by John Maynard Keynes.
Alasdair, as always, on behalf of all of our viewers and subscribers, thank you for joining us here again on Liberty and Finance.
That was very much my pleasure, DK. Thank you for having me on.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for May 12th through May 19th, 2025, while supplies last. First this week, we feature backdated 1-ounce gold American Eagles at just $89.99 over spot per ounce. 1-ounce 2025 silver American Eagles are just $4.99 over spot. Next, we have 10-ounce silver Royal Mint coins at just $2.99 over spot per ounce. The 10-ounce Britannia, 10-ounce Royal Arms, 10-ounce Little John, and 10-ounce Merlin are all 4.9s fine. And we have a very limited quantity. Again, they're just $2.99 over spot per ounce while supplies last. Next, backdated 1-ounce gold Canadian maples are only $69.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.